So when you're in these areas, there are certain things that you need right now. You must buy for cash flow, not appreciation. Okay. And this isn't my opinion. This is actually taught by the CCIM Institute that has been through many, many studies of multiple universities.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is, the trinity of freedom: time, financial, and geography freedom. I'm your host, Missy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I am on a mission to help hundreds of thousands of people like me to do the same.
Hey, welcome to another episode of the American Dream Builder and Investor podcast. Today, we have a special guest, David Monroe, CCIM. He's also a mentor. I know he usually doesn't go on podcasts because he's so busy looking at deals and teaching his students, but I'm very fortunate to have him on here with us today. One of his specialty is really about market analysis, cycle analysis, goes along with his CCIM certificate and designation. So I want to give you his formal bio. David is a multifamily investor and also strategic consultant, CCIM Instructor, which is Certified Commercial Real Estate Investment Member. And he specializes in multifamily investing, market analysis, and finding off-market opportunities as well. And he's been teaching real estate professionals that rely on real estate transactions for income to get paid before they can provide a service. And since January 2021, David has been building his consulting, education, mentoring, and coaching company to help multifamily investors get the first and next deal. But his real estate experiences started way before that. And we'll dive into that a little bit more as well. Essentially, David has been taking his real estate experiences, property management experiences, and his formal education as well to help real estate professionals survive through what he believes to be the coming recession. I know David and I may have slightly different outlook on the economy now in the next couple of years, but he's definitely well respected in the industry and in the CCIM world as well. He was also a U.S. Marine for 11 years, 4 months and 16 days, now that he's counting. They instilled into his core values about honor, loyalty, and integrity. And I feel good about saying those because I've worked with him for the last 2-3 years as well. His passion and focus to help as many real estate investors, agents, and brokers succeed in this very competitive industry is very highly sought after in this industry. So I know the bio doesn't do it justice, David, but I did want to give that bio because I feel like it speaks to your overall profile very well.
Thank you, Missy.
So welcome, David.
Thank you. Thank you for having me.
Awesome. Yeah. So apart from the general, bio that we talked about, can you walk us through your experiences within the marine area or how you went into the real estate and how has that enabled you to become a consultant and really helping others along the journey of their time, financial freedom, or just making that income that gives them the lifestyle they want?
So started specifically in multifamily. I got into real estate end of 2011. So like most, I have not been through a full market cycle yet, which is why I verify and rely on data to get me through the one that's coming. And I'm sure we'll talk about that as we move forward. Started specifically just doing multifamily around September of 2013 and never looked back. Became a CCIM candidate in September of 2012 with a goal to get my designation within 5 years. And exactly 5 years later, I became a CCIM designee and utilized everything I had learned from CCIM, all my underwriting, market analysis, everything to build my multifamily business, whether it was investing, whether it was brokering, or whether it was owning a property management company. Then right after getting my CCIM designation, they took applications for instructors. I put my name into the hat, not thinking I was going to get accepted right away. I just wanted them to know who I was because I had only been in CCIM for a year and made it through the process. And now I'm a senior instructor and teach market analysis for the CCIM Institute, which gives me a lot of credibility for having the conversation that I've been having on YouTube over the last couple of months dealing with what's going on in the market cycles, because that's what I teach for the CCIM Institute. And then along the way, after 2020 happened and deal flow fell off, I realized that I needed to do something to get cash flow up front and not because of a transaction. So I started my consulting business, my coaching business, my education business, and really have focused on growing that since about, December of 2020. And that's kind of where we sit now.
Yeah, those are interesting times you went through, especially the last few years as you began your consulting services. Let's talk about, for the audience who may be a little bit newer to this topic, a lot of them are busy professionals, maybe passive or active investors, newer or experienced. Let's bring everyone to the speed about the market cycles at a high level. What are the last, let's say, 5-10 years the market cycles we have gone through, in your opinion, and where we're at now? And we can dive into that a little bit more.
So obviously every market has its own cycle. Some lead, some lag. And we've seen that in the videos I've been doing over the last 2 months on my YouTube channel. So coming out of 2008, as we entered 2010, we started in the recovery phase. So there's 4 phases. There's the recovery phase, the expansion phase, the oversupply phase, and the recession phase. From about 2015 was really 2014, 2015, the occupancy and the rents were high enough where developers could start building again. And so we started seeing developers hit the marketplace in certain areas around the country going into that expansion phase. And that's when development occurs, is in the expansion phase. As occupancy increases, as rents start to accelerate because demand exceeds supply because there aren't units on the market yet, the rents tend to go up, keeping us in that expansion phase. Once we get to a point where demand and supply are equal, that is considered equilibrium. And as we continue to deliver units and as demand wanes and absorption, which absorption means over a period, whether that period is a quarter, whether that period is a year, it doesn't matter. When more units rent than go vacant in a market, that is considered positive absorption. When more units go vacant than get rented in that period, that's considered negative absorption. That tells you what the demand is for the supply inside that market area. And we have been seeing in almost every single market I've looked at, except for a couple, that all absorption levels have slowed to almost a complete halt. Some are already negative absorption in the third quarter, and a lot of them negative in the fourth quarter. And as long as those rents stay above, or as long as the occupancy stays above that long-term occupancy average. So we're allowed to look 22 years back in CoStar, which is the tool I use, to determine what that long-term occupancy average is. And CoStar shows it in their supply side snapshot. As long as our occupancy levels are at or above that, we stay in that oversupply phase. As those occupancy levels dip below that, we start to go into the recession phase. And about 10 to 15% of the markets I've looked at, again, I think we're going to hit 42 markets today when I do Fort Myers, Florida later today. I think that's the 42nd market I've looked at. I think 10 or 15% have entered that recession phase of the market cycle, with many thousands of units still left to deliver. My opinion, what's been causing this are the amount of rents that are of these residents. They just can't pay them anymore, so they're doubling up, which is what is affecting the demand. Obviously, in a lot of these markets like Dallas, Houston, Phoenix, some of the worst markets I've looked at, Atlanta, we know there's demand there. There are people moving there every single day. We know that. There is job growth there. But we have negative absorption, which means there's a lack of demand. So what's happening? People are moving in together. They're roommating up, or they're moving back in with mom and dad, or aunt and uncle, or brother and sister, or whatever they're doing. That affects your demand. And until the rents get back down to a more affordable level, we're going to continue to see that. And in all these markets with 20,000+ up to almost 40,000 units left to be delivered, we know we've got some ways to slide. But the good news with all those markets, if there's good news in all of this, is the economic drivers are there. So when those rents do get back down to those levels, these will be the first markets that will bounce right back up and hit that recovery phase right off the bat. So they will be the first to recover because of their strength. So that includes Atlanta, Dallas, Houston. We just did Austin, Phoenix, and Charlotte, which were some of the worst hit. They will be the first to recover.
Yeah. I think during the last recession, I think it was similar when I was looking at data as well. A lot of the major markets recovered faster if they had the economic drivers still there, like you mentioned. So it'll be interesting to see. And for those that's interesting checking out David's YouTube channel, we'll link it in the show notes as well. It's pretty good update. Real estate is local, so it's good to look at those specific data. And we'll definitely talk about the future outlooks and the buying opportunities, etc. But, with David and I talked about, rather than just teaching you, giving you the fish, we're going to talk a little bit more about the data, the thought process of how he looks at those things and what data he looks at. With everyone almost agreeing on, we're entering into a recession, even though, we don't have the GDP data yet to prove that out, right? But what kind of data points do you look at when you look at specific markets? Let's talk about both economic data points and also some of the socioeconomic data points as well, whether it's within CoStar report and outside. Let's say what are the top 5 things you look out for and what are the other details you also like to add.
So first, let me caveat these YouTube updates that I've been doing. These are strictly conventional apartments, meaning market rents, and they're strictly for apartments. So if you're in the self-storage business, this does not apply. If you're in the office business or in the retail business or it would apply to some of the single family rental data because it's still rental data, but I don't have supply side data for single family. So it really doesn't apply to single family. So if you're doing a build to rent, you really can't use this data because single family is going to be different. So I just want to caveat that. When we plot on a market cycle, whether it's me, whether it's Dr. Muller with his market cycle chart reports that he does, it is all based on supply side information. So what are the occupancy levels? That's the number one thing we look at is occupancy. If occupancy is increasing, rent should be increasing. If occupancy is decreasing, rent should be decreasing. And that's how we determine where on the market cycle chart it goes. So it's not only market specific, it's also asset specific. So when I'm doing these reports, they are specifically just supply side information. And I use CoStar as my tool to get that data because CoStar is the only tool that will give you information outside of the top 135 markets and under 50 units. All the rest of the data tools are only in the top 135 markets and only 50 units and above. And I don't think that's enough information.
Yeah.
So
I was just going to add, CoStar is a great resource. We actually had CoStar presenting to a local meetup that I host recently. They actually have a few other subsidiaries like Star.com for hotels, Apartments.com, and a few other places. So they have data, live data pulling from Apartments.com, for example, which, has a lot of the multifamily rental data, even single family as well sometimes. But anyways, just background information for your data source. What was the other point you were going to mention?
Be careful. And one thing I want to mention, because you'll hear this from certain gurus, and I'm not going to mention any names. Good places to go to find apartment rent data is Apartments.com and Rent-A-Meter and places like that. You'll get asking rents in those areas, not effective rent. So you have no idea what the vacancy is. You have no idea what the current inventory in the market is. You have no idea what absorption levels are. You have no idea what the concessions are in the market. So no, those are not good tools to look at. You need to build a relationship with somebody that has a good supply side tool that you can pay for, or get it yourself in order to get the accurate data that you need to make good decisions. So I just want to caveat that Apartments.com is not a good place to pull market rents from. Okay.
To get the complete picture. Yeah, I agree.
Correct.
While we're on the topic of vacancies and occupancies, one of my passive investments, this is probably on my first passive investment right now. I asked the sponsor this question. They're trying to go above the pro forma rent, but occupancy is below 90%. I'm just trying to understand why, are they just trying to talk people? They're beating their pro forma rent. That sounds good. Why aren't they decreasing their rent? So I feel like people are trying too hard to look good. That's my impression. Like I would have been decreasing the rent just to improve the occupancy. And I think it's a win-win across the board for the community and then for the investors and for the general partners as well.
It's a great point, Macy. And it's an unethical practice doing that. Your rent should be determined by your occupancy levels. Prior to COVID, most markets, especially in the Southeast, they used a software tool that actually changed your rent based on the market occupancy on a daily basis. After COVID, they went away, and I don't know why they went away. And now the sponsors, they just drive rents up. Now, not every market. We've seen it in some markets, not seeing it as much lately. But in the first few markets we looked at, we saw where, especially in the Class C markets, that the sponsors were just driving rents up, even though there was no demand. Now, let's remember we have a long-term occupancy average. So depending on what market that's in, if the long-term occupancy average is above that 90%, then I would agree with you. They need to be lowering rents, not raising rents. But there are some markets, like we looked at Fort Collins, Colorado the other day, where the Class C market was increasing in rent, even though the demand showed that there was negative absorption. But the long-term occupancy average was 93%, and the Class C market was sitting around 95, 96%. And there isn't a single sponsor out there in their right mind that is going to lower rents sitting at 96% occupancy, especially when a lender is going to underwrite you at 95% minimum. So driving those rents further up to get the occupancy a little further down makes sense in some markets. But when you're below that long-term occupancy average and you clearly have no demand for the rents that you're charging, increasing your rents, all it's going to do is increase your vacancy. And eventually it'll get to a point where they'll drop below their DSCR, and then they'll really be in trouble.
Yeah. So those are essentially my question, is the property manager not trying hard enough to fill the units? Or is there not enough demand? We need to increase the overall revenue numbers. So that's kind of one point related to a real life story on the occupancy part. The other part that the listeners are interested in is, how much of in the market, below what occupancy should we be paying attention to and having the alert flag, and how much of an occupancy drop within a year is alerting as well, in your opinion?
Any occupancy drop. I mean, that is telling you if you have 2 straight quarters of occupancy drop or 2 straight months of occupancy drop. I look at the data on a quarterly basis. I know that CoStar reports on a monthly basis, but they don't show the data on a monthly basis. Oh boy, do I wish they would, but they don't. So I can only see it on a quarterly basis. And when you're seeing your occupancy go down, obviously there's an issue. Is the issue with the rents? Is the issue with economic drivers in the market? Or is the issue with the management company? And so you have to start to look at all those factors and see, and start with the management company, obviously, and then look at the economic drivers. Did a company move out causing people to go with it? Or are your rents just too high?
Yeah. Yeah. So is it something that the property management team can control, or is it more regional? Or so yeah, those are really good questions. Now, coming back to the other data points, I know we started the question with what are the data points to talk to a CoStar, occupancy, rent. What are some of the key things you look for that brings you alert?
This podcast is sponsored by Life Mission Capital, founded by me, Missy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
So economic drivers, I said that these bigger markets along the Sun Belt will recover faster. It's because there are companies that are moving to these markets. When you have economic drivers like that, and it's not just any company. So that company that's moving there or that company that is growing needs to be selling their goods or service outside the local market. And that way there's money coming into the local market from outside. That is considered an economic driver. So what happens then is that creates demand. So as jobs move in that are considered, we call it basic jobs, which are economic driver jobs, as they come in, that will increase your population. It will actually increase your total job market because of a multiplier effect that will happen. So when you end up in a situation like we're in now, where the rents are just too high and people are roommating up, which will affect your demand, that's why when you look at the jobs that are coming, when there are people moving to the market because of these economic drivers, that's what allows you to recover faster. So that's how you can identify. So when you hear people say that it needs to be a growing market, even though when you look at the numbers look like it's shrinking, your population's growing, your basic job or your economic driver jobs are growing, then you know you'll recover faster. And so that's a great way to be able to tell that.
Yep, that makes sense. Economic, employment, job diversities, they're all very important factors for multifamily investing, and also that depends on the balance of appreciation and cash flow, because the economic drivers will help with both ability to pay for the rent, and also when you can sell, the income is still high because people are still paying for their rent. When it comes to the topic of economic diversity, is there any specific percentage of jobs you think that's good for, like, from one company or one industry? For example, from Northwest Arkansas, where I live. By the way, David, you should do a market update on this one.
It's on the schedule.
It's on the schedule. Okay, awesome. We have a few major employers in the area. Probably top 5 to 6 make up a majority. I don't know the exact number, but probably a good 30% of the population, I would say, in terms of jobs. What do you think of that in your employment-based analysis?
Well, so there's more to it than that. You can't just look at what your major employers are. You have to look, are those major employers in an economic sector? So like if one of your major employers is a hospital, like Mobile has the largest employment in Mobile is education, the largest employer. But education is not considered a basic employment sector here because other than South Alabama University, we don't have very much education here other than our local education. Where in medical, we do with the hospitals that we have, because our hospitals cater to the region, they don't cater to the local area. And so there's money coming from outside the region into the local area because of those hospitals. That is our second largest employer in the marketplace. That one is an economic driver. So you've got to determine by NAICS sector, what is that largest economic driver that you have. So if your largest employer is your education system, but your education system isn't an economic base sector, you can't use that. It's irrelevant information. That's just local money.
Yeah.
Versus an economic sector like manufacturing. Most manufacturing would be considered economic drivers because you're not building for the local economy, you're building usually globally. Other sectors would include hospitality, which if you look at Las Vegas and Orlando, hospitality are your largest. Leisure and hospitality is the sector. Those are your largest sectors, which we call those two markets one-trick ponies because of the amount of industry that is in leisure and hospitality. And the reason you don't want something that is that specific, like Mobile, manufacturing is huge in Mobile. Now we have some other things here. We have the port, so we have transportation and logistics, but that's really it in Mobile. So we're kind of a manufacturing one-trick pony, where Las Vegas is a leisure and hospitality one-trick pony. Orlando's got some other industries, but your largest industry still being leisure and hospitality. So when something happens like COVID and leisure and hospitality shuts down, that greatly affects those markets. And it's why you see markets like Las Vegas and Orlando, they'll hit the bottom faster than most, but then again, they come back up faster than most. So they have really low lows and they have really high highs, and they do it fairly quickly. And then they'll stay in
Hmm.
those. Well, they'll stay high longer, where they won't stay low very long because those economic drivers will drive them right back up again.
Hmm. Yeah, I think the key lesson to take away from the conversation is that the markets are different and you just have to learn how to take advantage of them. It's
Correct.
not saying investing in Las Vegas is bad, but there are certain risks embedded in there. You have to learn how to mitigate those risks with your reserves or learn how to buy them properly. So you have a bigger risk, bigger reward, perhaps. Now, going back to the conversation of my example of Northwest Arkansas, it's very economically diverse in terms of it's from transportation industry, manufacturing industry, university, retail, and most of them are all very recession resistant, especially with Walmart being more of a, well, my headquarter being more of a low cost retailer. So those are some of the factors we consider as well when I decide to buy some of the personal properties here. Um, so, to recap, number one, understanding what's happening with occupancy in the market is doing reports like CoStar reports. If you guys need to access that, I do have a person that can get you access to subscription there as well, and also economic drivers that will help determine rent. Anything else that's really top indicators for KPIs for you right now?
So we're in what is considered the plateau phase, entering into crisis phase. That's plateau would be considered oversupply, crisis would be considered recession when we talk about the phases of the market. So when you're in these areas, there are certain things that you need right now. You must buy for cash flow, not appreciation. Okay. And this isn't my opinion. This is actually taught by the CCIM Institute that has been through many, many studies of multiple universities. So in the financial world, in the plateau phase, you must not buy for appreciation. You must buy for cash flow. Your cap rate, going in cap rate, today's cap rate must be higher than the interest rate you can get on the loan. Otherwise, you're in negative leverage. Okay. So you'd be better off paying cash for the property than getting debt if that cap rate is lower. If you are paying cash on the property, then it's irrelevant. It doesn't matter what your cap rate is. It's just based on your risk. If you can get a 75% loan to value today, I don't care if it's Fannie, Freddie, everybody hears, oh, it's because of the risk in the market. No, it's not. It's because your debt service coverage ratio in year one is too low. And so they will only give you 55% loan to value. If you were underwriting correctly to the appropriate value of today's financials, then you should be able to get a 75% loan to value even from Fannie or Freddie. It's because you're being capped by your debt service coverage ratio in year one. That's what they do. They loan to the minimum of debt service coverage ratio or loan to value. So if they'll only give you 55%, it's because your debt service coverage ratio capped you at 55% loan to value, right? So those are the big things. Making sure that it cash flows, making sure that your cap rate is above your interest rate, and that you can get a 75% loan to value. It's kind of more of a test than making sure of. And if you buy that way today, you can make it through this recession. Those that bought in 2021, they're going to be in a lot of trouble because they bought with short-term debt at very low interest rates. With interest rates more than double now, and those loans now coming due, they're going to be in a little bit of a pickle. So don't put yourself in that position.
Yeah, it's hard to know what really, well, it was a cycle, right? We had low interest rates, so we expect the rates to go up at some point, but it was hard to say when. The same now, the rates will come
Not
down
blaming anybody
eventually.
for anything, just they put themselves in a pickle. If they'd have done proper fundamental underwriting, they wouldn't be in this position.
Hmm. Yeah. So with the cash flow piece, a lot of the things that we're looking for right now is long-term debt. If you can get into longer-term agency debt, just because it's really hard to say where the interest rate will go. Most of the indicators say that we'll continue to have high interest rates for some time, but how long? Are we going to go into a stagflation type of period for a few years? What are your thoughts around that?
So here, I use, again, data-driven approach, right? I look at data. The data says that the Fed will not lower interest rates. Depending on how high we get, this is just an opinion. My opinion says that we will hit double-digit interest rates, not the Fed fund rate, actual interest rates to buy a property. We will hit double digits prior to it starting to come down. But it isn't going to be the Fed driving it down. The Fed is going to step back, say, okay, we captured inflation. Our target is heading to that 2 percentile that they like to see for inflation. And when it gets there, the Fed's just going to step away and say, okay, market, tell us what our interest rates are going to be. And the market will take over at that point. Between the equities and the bond market, they will determine what interest rates will be based on where volatility and fear is in the market. And I think we will settle at our long-term interest rate. If you look back over 50 years in this country, we sit somewhere between, in 80% of that time frame, we sit between about 6 and 8% interest. And that's where we're going to settle. I think we'll settle on the lower end, so probably somewhere around 6.5%, 7%. I don't think we'll settle on the upper end, but I think somewhere between 6 and 8%, we're going to settle there, and we're going to be there for some time. 5, 6, 7 years until the next major event occurs that gives the Fed the tools, the ability to lower interest rates again. But until that happens, we're going to sit at long-term rates. That's just my opinion, utilizing what we've seen in the past in this country and current data to come up with that assumption.
Yeah. Yeah, I always love a data-driven approach. And, there's a lot of variabilities in the market. That's why there are so many economists holding different point of view as well.
That's correct.
I will actually also do a solo episode of this about my view of the economic outlook as well, probably in the next episode after this. But what are your thoughts on the stagflation? If it were to, because what you presented is kind of a bad scenario for consumers and maybe investors, depending on how you can leverage that market. Stagflation, I wouldn't necessarily say the Great Depression, but where interest rates are high, it suffers for business, suffers for consumers as well.
Yeah, but
How do
right
you,
now interest rates aren't high, Misi. Interest rates today are on the low end of the average. It's not high right now. It's only high to most people because most people didn't enter the marketplace in the investing world until after 2008. Prior to 2008, we were sitting around 8% interest. So it wasn't until the Fed drove it down to nothing that we entered that low interest rate environment. That is an anomaly. We've only been there twice in this country's history, and we were only there for short periods of time. This one happened to have been a very long period of time, and everybody thought, okay, this is the new normal. No, it's not a new normal, obviously. So we are not in a low interest rate. We are not in a high interest rate environment right now. And I think we will settle right back down to kind of where we are now, maybe a little bit higher, but kind of right where we are. As far as stagflation is concerned, stagflation just means that we have job growth with high interest, with high inflation, kind of where we're sitting. And it's why the Fed needs to get off their butt and stop doing these little 1/4 and 1/2 point and 3/4 point raises and start raising these rates to where they need to tank the economy. Until they tank the economy, we're going to continue to see inflation climb up. Keeping in mind that, and a lot of people don't know this because nobody's talking about it, that in January, the federal government, not the Fed, the federal government changed the way it looks at inflation. So we're no longer apples to apples. So where we saw in January, we had a 6.7% year over year increase in inflation, which was down from the December number. Then in February, when we saw last month, because we're in March now, Last month, when we got the new number, it went down to 6.6, but it wasn't apples to apples because in January, after the other inflation data come out, they changed the way we look at the data. So it's no longer apples to apples. So where it looked like it went down year over year by 0.1%, look at what it did month over month. It went up 0.5% month over month. And that was the biggest number we'd seen in over a year. And wholesale was even worse. Wholesale was 0.7% month over month increase. So unfortunately, it's very difficult to determine where inflation's going to be because they keep changing the way they show the data. But what doesn't change is the month over month increases. So pay attention to month over month.
Yeah, that's an interesting data point I haven't paid as much attention to. Thank you for pointing that out, David. I think with someone with data analytics background, how they change, like you said, the CPI calculation with inflation numbers, or how they calculate a jobs report. Some of us were suspecting, the jobs report last month wasn't really, I guess this is January now. January report wasn't that true. So, and also our market basket analysis of the inflation on market basket has changed as well. So it's important to understand what's driving those data as well. But what do you think about, speaking on the topic of inflation, when the Fed government has printed so much money during COVID time and the money won't just evaporate, even though we'll have economic initiatives like the interest rate increasing, for example, to change things, to reduce jobs perhaps, or put more money into savings. But whenever the rate changes, the money will come back again. And what are your thoughts about how is the amount of money that was printed really going to affect our next couple of years or beyond?
Well, you're already seeing it.
But what do you think it's going to continue to look like?
If the Fed doesn't raise rates faster, we're just going to continue to see inflation grow because of all the money that was put in the marketplace. The Fed needs to lower their balance sheet. That's part of what they're doing with raising interest rates. They've got to get rid of all those assets on the balance sheet. And until they do, we're going to continue to see the route we're going.
Yeah, absolutely. Well, thank you, David, so much for your time today and kind of going over what you look out for when you look at a market, when you look at a specific deal, and some of the key things that either sponsors or investors aren't paying as much attention to during this changing market. I also appreciate your insights on the next few quarters or the next few years, what you think may be happening. Those are definitely the things the investors need to be paying special attention to. Is there anything else you'd like to leave with the listeners before we end the call today?
Just pay attention to the data, use correct fundamental underwriting procedures, and get third-party backup if you need to. If you're trying to vet a sponsor, don't rely on what the sponsor is telling you. Get some additional information. So that's the best advice I can give right now.
Awesome. If anyone wants to reach out to you to learn more about what you do and some of the things you're working on, what's the best way for them to reach out to you?
David at davidmonroeccim.com.
Awesome. Thank you, David. Again, we'll link David's contact and also his market update channel in the show notes below. So feel free to connect with him. And thank you so much again, David, for adding value to our listeners today.
Thank you, Missy. I really appreciate you having me on.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Missy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.